I keep seeing titles like indie artists get 150,000 tax credit. Indie artists are getting this tax break of $150,000 as part of the big beautiful bill, and specifically the HITS Act. So Help Independent Tracks Succeed Act. But once again, what people are saying is wrong and misleading. So I want to dive into this. I'm not a CPA. I'm not your CPA. Okay. I'm not an accountant. I work with a lot of CPAs. So I'm very familiar with how this works. And I also have lots of businesses. So what I want to do is to walk you through this so that you understand. Let me start by planting a seed. In order to even get $150,000 as a tax break, a tax credit, you would have to spend $150,000, which means you also need to make $150,000. Well, actually, let me put it this way. In order to even be eligible, right, to say that we're going to use this tax credit of up to $150,000, it's going to apply to you. How much money you're actually making, how much money you're actually spending on your career is really important. This actually is going to be good for some people, but what we're looking at is what's going to be good for the average independent artist, and does this even apply to the average independent artist? And I argue it does not. Now, the other piece of this is that it's claiming, or at least how I'm seeing it interpreted, is that independent artists impliedly could not do something before that they can do now, again, which is not true. So the HITS Act basically does this. If you spend money to record music, you can deduct up to $150,000 of those costs per year. That sounds great. Obviously, I'm seeing this content and just people are like, go get the best mixers, get the best mastering engineers, pay the best songwriters. And it's a little bit misleading. What this actually applies to are mid-sized music businesses. And so let me explain why. The way that it used to work is that if you're like a big boy music business doing real big numbers in your expenses and you pay, let's say, $100,000 to make an album, before, you wouldn't be able to write that off right away. And so it's this idea of amortization. So you amortize, you pay slowly over time. So the government came up through the IRS with these rules, and they go, if you're going to make an investment, a big investment, you don't get to write it off right away if it's something that's going to make you money over time. So they go, you get to write it off over many years. So often, if you pay $100,000, you would only be able to write it off in like little chunks, 3 years and sometimes up to 15 years. So it's a long thing. The really important thing you need to understand here is that there's ordinary business expenses, travel, gas, mileage, meals, marketing, office expenses. These are the expenses you incur as part of just running a business. And PS, you don't have to have a proper business like an LLC, right? An established entity. If it's just you, John, and you are running under a business name, John Studios, and you're a music producer, you have what's called a sole proprietorship. So you are still kind of conducting yourself like a business. The downside is that it really is just you. If you, the studios, get sued, it really is just you getting sued. So the big reason why you want to get the LLC is because it gives you a liability shield, it protects you, it's all super great. Why do we care about this though? Because in this category of expenses, we have your ordinary expenses, which you can always go and deduct. Doesn't matter. You don't even have to have an LLC or a corporation or anything like that. You go to file your taxes, you tell the government that you spent so much on your ordinary business expenses, and you get to deduct them before the HITS Act and after the HITS Act. But over here in this little bucket, they're called capital expenditures. These are long-term assets. These are different. So that's why I said for mid-size businesses, this is really what or who this is benefiting, because the average independent artist is not going and dropping $100,000 on an album. Now, some of you may, I have clients that certainly have done these kinds of things who are independent, but the average independent artist is not spending this kind of money. So that's when my initial spidey sense went up as I was just kind of reading more about this. So what happened? So as far as that piece on paying slowly or deducting slowly over time, that was taken away. So that's why this is a good thing potentially. So that now, if you paid a whole lot, your $100,000 to make your album, you can go and ask for it to be deducted in that same year that you made it. So that's a really good thing. But nothing actually is changing for most independent artists. Again, you could and you still can deduct your expenses, your studio time, your equipment, your promotion, because they're your normal business expenses. Again, looking at the people and the companies that this is really benefiting, we go to large independent labels, mid-sized music companies actually spending $50,000 to $100,000. Now, let me go to one of the articles that I stumbled across today. All right, this is from Music Business Worldwide. So A2, I'm not sure how to say it properly, and Recording Academy, welcome congressional passage of HITS Act. All right, so the American Association of Independent Music and the Recording Academy applauds Congress for passing the HITS Act. The legislation, also known as HITS Act, will allow recording producers and independent artists to deduct up to $150,000 in recording expenses immediately rather than spreading across multiple years, right? Amortization. The organizations led advocacy efforts for the measures, okay, and this is with over 700, and this is the important piece, supported by a network of over 700 independent labels to build support across congressional districts and states. The HITS Act will soon allow independent artists, songwriters, and labels to enjoy the same tax incentives that are already being enjoyed by their counterparts in film, television, and the live theater sectors. In film right now, there's, I believe it's section 181 of the Internal Revenue Code. And so basically right now, TV, film, they get to all deduct all their expenses across the board. So what they're saying is that, it's like Pharisees. If the film industry has this tax incentive that you get to deduct all of your expenses to make your film, well, music creators should be entitled to the same thing. Again, that's not the problem that I have here. The problem is that if you're like, well, we're just equalizing the playing field and this is so great for independent artists, it's the independent artists. I'm like, who are we talking about right now? And let me ask you guys, please drop a comment below right now. For the last album that you produced, how much did it cost you? Drop a comment down below and let me know. I'm curious. Who is this benefiting? It's large scale recording companies, projects. And if you happen to be one of them, okay, great. This is good for you. And what you need to keep in mind is that you're still capped. So if you now are spending, let's say, $200,000 on an album, then you still are only going to be able to claim up to $150,000. So that means now you still only get to deduct in small chunks over time the additional amounts. So keep that in mind. It only also applies to sound recording production costs. Again, remember, category little or, bucket of ordinary expenses over here. These are never impacted. You always get to write off your ordinary business expenses, okay? So it's specifically just these recording production costs. And then it's not going to apply to the super giants, okay? So obviously like major record labels, as far as tax purposes, if you have a certain number of employees, if you make a certain amount of money, all this stuff, then you are also going to be taken out of consideration. So it's going to be like, again, these mid-sized businesses here. And that's why I have a problem with this because, I keep reading, it's all, this is so for the independent artist and whatever. And I'm like, who are we talking about? All right, so bottom line, for the far majority of the independent musicians that I know, they don't even make up to $158,000, let alone they're not going to be spending up to $150,000. And I think there's a whole group of businesses, predatory businesses that are going to use this to say, oh, you need to go and pay your top tier mixers, go and pay your top tier mastering engineers and whoever you should work with and pay towards and all of that. But I think people are misunderstanding how this works, who it applies towards, and again, the nuances that we went through, okay? So as I see it, the real winners are mid-size indie labels, sync houses, and production companies, not the average independent music creator. And I have already seen those encouraging you to invest really your life savings because it's now tax deductible. Again, which is very misleading. Here's what you need to just keep in mind either way moving forward. For your tax purposes is you need to keep a track of all the stuff that you pay for that is a business expense because you can always deduct your ordinary business expenses and you don't even need to have an LLC or a corporation. It can just be you. And actually, it's on your Schedule C when you go to file your tax return. Okay. But again, this is the reason why it's a real good idea to get a limited liability company because having a business set up gives a liability shield for you, which is great. But also having a business bank account means it's the only place that this money will go into, come out of, and it's real clean. It's real clean for tracking. Now you have bank statements and I don't know. It's honestly one of the first things that you really should do. If you haven't yet, please consider. So stay protected, keep good records, and now you know what the HITS Act is all about.